Awesome. Yep. Thank you. So yeah, my name's Corey Daharsh. I'm a self-directed retirement account investing expert. I've been with the company for about 9 years now. I started processing accounts receivable and payable. Then I moved into account management where I had a roster of over 1,000 clients assigned to me, and I'd handle their transactions, questions about strategy and structure for investments. And then about 5 years ago, I switched over to what I do now, which is business development, where I just do these types of educational presentations. I network within my local community. I'm here in the Charlotte area and just teach people that self-direction exists, how they can utilize it. And then the basis of it, self-direction. I'm not here to overly sell the product. People find out for themselves if it fits their needs well and that it's an opportunity that they can have. And usually it does better that way than if I were a used car salesman breathing down people's necks. So I do have what's called a CISP designation. That stands for Certified IRA Services Professional. I had to take a week-long course, take a test, obtain that in 2018. And then I have to do continuing education credits every year to keep that in good standing. So for lack of a better term, I'm an expert in IRS rules and regulations and what you can and cannot do with your retirement account. Um, what I'm going to go over today is just the basics of a self-directed account and a little bit about Advanta IRA as a company background. And then I'm going to hyper focus on real estate investing, various rules and regulations you should be aware about, and a few case studies as to how you could turn and invest into real estate with your retirement account. If anyone has any questions, please feel free to ask them. If they're relative to what I'm speaking about in the moment, please ask them and I'll address them right then so you don't have to hold on to those questions till the end. And anything that's not really relative as I'm speaking, if it comes to your mind, jot it down and I'll ask as a general portion at the end of my presentation what other miscellaneous questions you may have that I can answer for you. So Advanta IRA is a company we've been around for 21 years. We've got about 15,000 active clients, and we've got just over 3.5 billion in assets under administration, meaning that our clients have $3.5 billion that they've taken out of their fiduciary or managed retirement accounts and moved them over to us so they can invest into various things like real estate, like cryptocurrency, like hard money lending, a lot of different asset classes, which I'll get into a little bit more deeper in the next few slides. But really, we partner industry-leading customer service. So having a dedicated person to reach out to with this product or this account type of self-directed accounts that not a lot of people even know exist. So we're leading the industry in customer service and pre-educational content, and we are very cutthroat on our fees as well. A lot of people think, oh, it's going to cost me thousands and thousands of dollars to have a self-direct account. Most clients pay us a few $100s a year. I'm not going to get into the exact dollar amount. If that's something you're interested in, you could email me directly, and I'm happy to forward you our fee agreement as a PDF. But we're very on the lower end of the cost structure in the industry and at the higher end of the customer service and free content providing side of the industry as well. Before I get too deep into anything further, just a brief disclaimer. I'm here to share educational information. I'm not a tax expert, a legal expert, a financial expert. I'm an expert in IRS rules and regulations. So before you make any investments or switch over to a self-direct account, if you're thinking about it, make sure you understand you have to do your own due diligence with your own team. We do have referral partners we can point you to in the avenues of tax advice, legal advice, financial advice. But we're not here to provide that service. We're not a fiduciary or a financial advisor. So we offer the product. It's up to the client to choose how and where they want to, quote, self-direct once they have the account set up. So a self-directed retirement account, as I just stated, it's one with a company that's not a fiduciary or a financial advisor. So the assets that you can invest into expand far beyond stocks, bonds, and mutual funds, which you might think or might have thought are the only things you're allowed to use for your retirement account investing. That includes real estate, which makes up about half of our client base, private lending. So you could actually issue a promissory note or a secured loan like a mortgage to somebody with your retirement funds, cryptocurrency, precious metals.
That's funny.
There's a number of different asset classes that you could invest into. I'm sorry, is that a question coming in?
I think it was just
Sorry.
hot
Oh, no worries. I just wanted to make sure.
the bills. No, I don't need to. Can you?
So there's a lot of number of asset classes you could invest into. It's easier to actually tell you what you can't invest into, which I'll cover in a few slides. But the accounts are very vast and very broad as to what opportunities you have if you did set up a self-direct account. Now, setting up an account is something that is part of my job on the business development team. Most people are familiar with a traditional and Roth IRA, which can be self-directed, but there's other account types also that we offer. If you're a small business owner or self-employed, maybe you are a real estate professional and you route that through an LLC or something like that, or even just sole proprietorship, you can set up a solo 401k plan or a SEP or a simple IRA account. It's a little bit confusing. SEP and simple IRAs, they are individual retirement arrangements, but they are small business plans. So those are plan types with higher annual contribution limits than your traditional and Roth IRA, but they only fit your needs if you're self-employed and have either no rank and file employees or a very limited number of employees in that entity, whatever it may be. We also offer health savings and education savings accounts. So if you're someone with a high deductible health policy, or you have a young one in your life, you'd like to set aside tax sheltered money, grow it through investing, and take it out tax-free for qualified educational expenses, that's a great product as well. Reach out to me if you have any questions. My job is, again, to talk through someone's current account types and what their current status is from employment and so forth, and figure out what the best account type would be for them to self-direct. Now, why do people switch to self-direction? You could already be investing and find this as a new source of capital. Hey, I'm already a real estate investor. I didn't know I could tap into my retirement account to bolster my portfolio. A lot of people are getting fatigued with the stock market. So just riding that wave is getting kind of tedious or frustrating. So even if you don't switch all of your account over, just diversify, break off a chunk and start self-directing it to see if you can't drive better returns in the stock market. And then the tax benefits of making these investments, I'll get into that a little bit further later on when I go into some of the case studies for real estate investing. But retirement accounts are not subject to capital gains tax when you make an investment and then sell a piece of real estate. And the income that you're generating is passive income. So it's growing either tax deferred in a traditional account, meaning you don't pay taxes on that money now, but you will pay it later when you draw that money out of your retirement account to start using for personal purposes. Or it's growing completely tax-free if you're doing this with a Roth account, meaning you paid taxes to put that money in that Roth account at that time, and then you grow it completely tax-free and never have to hand a dime over to Uncle Sam in the future. Now, getting these accounts funded, there's a lot of misnomers about what the kind of timeline is and what the criteria is. A lot of people think there's a tax event occurring when they fund these accounts or that it's going to take way too long. I want to break all those misnomers here pretty quickly. So most accounts are funded with what's called a custodian to custodian transfer, meaning you have an IRA with a managed company and you want to move it over into a self-directed IRA. That is a very simple, sweet process. That's a non-taxable, non-reportable event in the eyes of the IRS. You just fill out a transfer request form for the company you want to receive the money, and they submit it to the company currently holding your money. And those are usually wired within about 3 to 5 days, sometimes 7. It sometimes can be a little bit longer. There's what's called a medallion guarantee that some companies require, which is basically a notary in the finance world. So with that, you have to deal with mailing the original wet ink signature to the receiving company, and then sometimes having them mail it to your current company. So all in all, you're looking about a week to a week and a half. I have just about every custodian under the sun in our CRM. So as I'm talking through onboarding with someone, I can give them a reasonable expectation of what the timeline looks like. But again, custodian to custodian transfer is like accounts. So traditional IRA to self-directed traditional, Roth to self-directed Roth. And it's a non-taxable, non-reportable event done in about a week and a half or so. The other common way that people fund these accounts are by rollovers, which is when you initiate a distribution out of an employer-sponsored plan and roll that money straight into a new qualifying plan. You may even already have done a rollover, so you have an account with a fiduciary called a rollover IRA. That's just a traditional IRA funded via rollover. They use that term to just kind of label their accounts, but all it is a traditional IRA that was initially funded with a rollover. So breaking that down a little bit further, when you have an employer-sponsored plan and you leave a job, your money is usually still going to stay in that account unless you do that rollover IRA process. And in many cases, you're not benefiting from that money after the point that you terminated that employment. They'll keep your money and they'll keep investing based off of it, but they may cut you out of the profit sharing from that pool. So whatever the dollar amount in your account was from the day you left that job, it may not be growing. And you may be sitting here 4 or 5 years later hearing this for the first time. And again, as mentioned earlier, you may just get your statement monthly and not really recognize or realize this, but that could be the case, in which scenario, why not roll it over where you can start growing that money more? Because they're otherwise investing based off of your money, but not letting you share because you have left that job. If you have a current employer and you're interested in doing a rollover, that may be possible, but it is a case-by-case scenario dictated by the plan agreement between your employer and the retirement account company they're using to administer that plan. The specific term you'll want to ask is if you're eligible for an in-service rollover. So you either ask that to your benefits department or to the retirement account directly. Hey, I'm currently employed. I want to start self-directing some of these funds. Am I eligible to do an in-service rollover? It's case by case depending on that plan agreement. So every company and agreement under the sun is going to have a different rule here. A lot of times there will be provisions once you've already reached the IRS retirement age, which is 59 and a half. You may be able to start self-directing some. You may have a provision that says if you've worked with your employer for 10 years, 15 years, you can start directing some. And it may just say, nope, once you are in this plan and employed here, your money's stuck here until you quit this job. So I can always help make those phone calls, but the basis of it is in-service rollover is a specific term you want to ask about. Now with rollovers, as long as you're keeping the tax status of the money the same, so traditional or tax deferred 401k, 403b, thrift savings plan, whatever it may be, to a self-directed traditional, you do not have a tax consequence. It's reported to the IRS in this case. So the distribution out of plan A is reported to the IRS, as well as the rollover into plan B. And as long as the dollar amounts match, there's no tax consequence or tax liability for you. In certain scenarios, you may want to do a Roth conversion. Again, consulting with your CPA or tax preparer if that's a good idea for you. And that's typically called a direct rollover, when you just move the funds, make the check payable directly to your new retirement account. You can do that as frequently as you want to, for whatever dollar amount you want to, as long as you're eligible to do so, meaning you've already terminated employment or you're eligible via in-service rollover. Another way to do a rollover is called an indirect rollover. So that means you actually make the funds payable to yourself. You have 60 days from constructive receipt, meaning the day the check hits your bank account, or if they wire, which 9 out of 10 times they will only send a check, the day the wire hits your bank account, you have 60 days from that point in time to move this money back into a qualifying plan to avoid receiving a tax consequence or distribution, taxable distribution for taking this money out. You're also only allowed to do an indirect rollover once every rolling calendar year. So if you did one tomorrow, you have to wait 365 days before you're allowed to do another indirect rollover. That's often also referred to as a 60-day bridge gap or 60-day personal loan out of your retirement account. Is way less utilized than the direct rollover or IRA to IRA transfer strategy, but it's out there. If you're needing to float yourself some money and put it right back into a qualifying plan, it could work for you. So the next thing I want to talk about is the rules and regulations I hinted at earlier. There's a lot of different asset classes you could invest into with one of these accounts. And the only way the IRS restricts these is by labeling certain assets as subjective in value. So you think about antiques, fine wine, artwork, anything that doesn't have a static or a black and white valuation to it, the IRS doesn't want you to hold in your retirement account. And also labeling certain individuals close to you as disqualified persons, meaning you can't transact with these people. You can partner with them. So your retirement account and a disqualified person's retirement account can partner together and go in 50-50 on a piece of real estate, for example. But you can't own that real estate and then let a disqualified person be a tenant at it. Or you can't buy a piece of real estate from a disqualified person. And breaking down a little bit further what the disqualified persons are, that is yourself, your spouse, and everyone on your lineal family tree. So look up straight the main trunk of your family tree, your grandparents, your great-grandparents, your children, your great-grandchildren. And this also extends to any businesses that those individuals either own 50% or more of, or conduct day-to-day operations and make day-to-day decisions on behalf of. So cycling back again to an example, I can't buy a piece of commercial property and let my father's business be a tenant at that property. I can't buy a rental property in the town I'm sending my child to college in and let him be the tenant there. This does not extend to family, friends, and other relatives. So your siblings are not disqualified. Your aunts and uncles aren't disqualified. Your son's best friend is not disqualified. So those people can transact with your retirement account. It's specifically these disqualified persons and businesses that they own. Here's just a few examples. I feel like I just said 2 or 3 of these off the top of my head, but these are just further examples of disqualified persons transactions. So it's really important not to conduct any prohibited transactions. I just want to beat on this real quick. If you were to have been found to have conducted a prohibited transaction by the IRS, what they do is pretty hefty. So even if this happened in December, when they find out about it, they backdate your IRA account or 401k account, whatever it may be, to January 1 of that tax year. And they say your IRA ceased to be an IRA as of that date. You have to taxably distribute the entire account to yourself, and they also levy penalties and fines on a percentage basis against that amount that you're distributing to yourself. So that's why we're here as experts, to talk through investments before people make them and help people strategize with these rules in mind, how to maybe twist what you thought you were going to do to an allowable form of that investment with your retirement account. It's always important to also invest with people you know. So join these types of communities. Check out your local RIA group potentially before you make an investment. Build that triad of know, like, trust. Because again, as I stated at the very beginning of this presentation, we're not a fiduciary. We're not signing off on your investments from a good or bad perspective. We're saying, hey, the IRS will allow it. Hey, here's how you have to structure it. But we're not saying, hey, this is a good idea. You're going to generate XYZ returns on this thing. That's completely your underwriting due diligence responsibility. Now, when we hone in on real estate investing, there's a number of different asset classes people typically use. If you've already got a lot of money in your retirement account, then taking down a single family home or a multifamily unit or dwelling, or even a commercial property for income that's, rental driven, that's a case study and a usage that people do a lot. If you're just getting started, you could do the same thing by partnering with other individuals, and I'll get into some of the structure of partnering in a few slides as well. But if you're just getting started and don't even have enough money to go in halves on a piece of property, rental agreements are not going to work for you. So you can look at tax deed and lien investing. That's typically a few $1,000s. Options contracts or wholesaling, you can typically turn a few $1,000s into a larger profit that way. And a number of different things like private lending. Maybe someone needs $10,000 for a repair on a rental property they've got, and you could issue them that loan, secure it by that property, have a favorable maturity date, like a balloon note, and an interest rate that works out for you better than what you would otherwise earn in the stock market. A lot of different things you could do here in the real estate sector with your retirement account. Now, looking at rental properties, for example, when you're purchasing a property through your retirement account, the deed of title is going to show the retirement account as the buyer. And that's what's going to be recorded at the county level as well. Not yourself personally, not your social security number, the name of the retirement account, which in our case, the full vesting is something to the effect of Advanta IRA Administration LLC for the benefit of Corey Daharsh, IRA number, and then a 7-digit account number. And the tax ID number for that investor is going to be our company's trust tax ID number. So your personal social would never be tied to this property. For anonymity purposes, you may use an LLC or something like that. That's a whole separate topic I can get into if anyone has questions. But checkbook LLCs are often used in these scenarios, so that it's just Joe Doe Invests LLC or whatever you want to name it. So even your name as part of the name of the vesting here isn't conveyed for public record. When you buy a property outright like this, it's important to know all of the funds for the property come out of your retirement account. Now, there is a caveat. If you want to put an earnest money or an escrow deposit down just to get this property under contract, you're allowed to do that. But you have to get an addendum or an amendment made to that contract. Assignment is not valid because that deals with self-dealing. An assignment is you saying, I personally am going to assign ownership to this retirement account. That calls back to those disqualified persons rules I referenced earlier. So it's very important, if you're going to put something under contract and put some cash down on it just to get it locked in, addendum or amendment will have to be done in the future before we go to closing. When you're buying it outright, we'll overfund at closing by that escrow or earnest money deposit so that that gets returned to you at the closing table. So no money actually legitimately came out of your hands. All of the money for the purchase came through the retirement account. And then moving forward, all income and all expenses need to flow directly through this retirement account. So you don't want to go out and buy a $200,000 property if you have exactly $200,000 in your retirement account. You may be looking more at a $180,000, $185,000 property, just in case before you start generating rental income, you have some money if the roof needs to be repaired or walls need to be painted or any other upgrades need to be done to the property. Because if you are in a situation where your retirement account can't afford any expenses that come from that property, you'll either need to move more money into that retirement account via a transfer, a rollover, or a new annual contribution. Or unfortunately, your hands could be completely tied until you're able to do one of those three things, or borrow money from somebody in the name of your retirement account, which in itself is its own additional factor because your retirement account can only borrow in non-recourse terms. Think about it this way. Your retirement account is a different entity than you personally, and it's not a human being, so it can't sign a personal guarantee. So your retirement account can't open a line of credit or sign a traditional mortgage. You have to go through a non-recourse lending process, which is a little bit different, more tedious, higher interest rates, and more underwriting from the lender's standpoint than if you're just to go try to get a standardized mortgage loan. With the expense side of things, we make it real easy. We have an online portal for clients to submit expenses for their property. We process payment requests within the same or the next business day. You can also have a blanket authorization on file for your routine expenses, your utilities. Maybe you're paying for a cable package at the property. You can have an authorization on file for whatever vendors you'd like so that when they send the invoices to our office, and you have the cash in your account, we go ahead and pay that out directly. You get an email notice anytime cash flows in or out of your account so you can stay on track of it. And also, again, we have an online portal that you can log into 24/7, generate your own statements, filter what criteria you're looking for, what property you're looking at, things like that. So before I jump on to the next slide, which is maintaining or managing the property, I want to take everything I just talked to you about and apply it to a split property purchase. So for rounded example, let's just say 50-50. I want to buy a property 50% in my retirement account, and my father wants to buy the other 50% in his retirement account. So we go back to that deed of title situation. The deed of title is going to list undivided interest for my retirement account 50% and undivided interest for my father's retirement account 50%. And all of the cash flow in and cash flow out has to be paid and received at that 50% ownership level. That ownership is specifically designated based on the dollar amount you bring to the closing table. So that final item on the settlement and HUD statement, whatever portion of that comes out of your retirement account is the ownership percentage you're going to hold on that property. It doesn't have to be 50-50 as well. I've seen a husband and wife do a 95-5 split because the wife barely had any money in her retirement account. She wanted to participate in the deal. Most of the wealth of that family was in the husband's retirement account. So it can be any split, any number of partners. Does not have to be strictly a retirement account. So I could partner myself with my retirement account so that out of my savings and my personal self, I'm investing in the property. And then separately, I'm also investing as a retirement account investor. Any number of situations could come at play there. Harkening back to the LLC structure, that may work and help you in certain scenarios, but that's what your client account manager is going to speak with you about, just giving you the options, the opportunities, and letting you come to your conclusion with what strategy or structure works best for the deal. So jumping into maintaining the property. Again, as I mentioned earlier, yourself and your disqualified persons can't directly benefit the property at all. So you can't do any sweat equity on a property owned in your retirement account. It does not mean you have to get licensed, insured, plumbers, electricians, whatever it may be. You can just have a local handyman that you trust and has work on your other properties. That's perfectly fine. We have no rules or restrictions there. As long as it's not a disqualified person, that's allowable. You are allowed to step foot on the property, so don't think you have to be completely hands off. You're allowed to step foot and you're allowed to walk and inspect the work before you pay these vendors out. You just, for IRS example's sake, can't even change a light bulb per the IRS rules on these things. Once you're ready to rent the property, it's completely up to you. So you can use systems like HUD, Section 8 to find a renter for you. You can use a property manager that's going to cut into your profits, obviously, when you use a property manager. But you can certainly do that, and they'll kind of collect the money, hold the reserve, and then send the residual income generated to your retirement account for you. But you set the terms, whether it be through a property manager or HUD or just yourself listing the property on Airbnb, VRBO, Craigslist for that matter. You can decide, hey, I want a 3-month renter, I want a 6-month renter, I want long-term, I want to charge this amount for the rent, and I want to have pet disclosures and all this and that. It's completely up to you to designate and delineate how you want to handle that. Just make sure that they know that the agreements between your retirement account and that tenant, not yourself, and that you know you're not the one actually signing the binding lease agreement. It's Advanta IRA on behalf of your retirement account and that tenant. You'll send it to us. We'll make sure you read and approve it, so you authorize us to execute it. We're not going to sign anything that you don't tell us we're allowed to, but your signature is not legally binding on behalf of a retirement account owned property. That goes to the administrator or custodian, which is what our role and responsibility is. Now, taking away from physical real estate investing, there are other asset classes that we see very commonly. First off is real estate syndication. So you have a general partnership team that puts together typically a larger project, whether it's rejuvenating an old apartment building or something like that, commercial space. The general partnership team puts together the deal, and then they raise money from limited partners. And that's what you would be going in as with your retirement account, a limited partner. So you're basically generating mailbox money, money that you don't lift a finger, do any sweat equity on, because you found a team that's put together a project, you believe in the project and think they have a good running action plan for the deal. In most cases, you're looking at about a $50,000 minimum threshold for a limited partnership syndication. They may or may not require investor accreditation. And typically these deals go full cycle in about 5 to 7 years roughly, with a preferred distribution coming out each year and then a lump sum payment coming to you at the end when the deal goes full cycle. I've got a case study on that on my next slide, so I'll break that down with rounded numbers and examples that are realistic, but again, not going to be exactly what you see in that scenario. Then after that, we're looking at fix and flip investing. So maybe I just want to buy a distressed property, upgrade it with the residual cash or remainder cash I have in my retirement account, or maybe I can buy the property and I've got a joint venture partner that has real estate construction expertise, how to develop property or land, or maybe owns a construction company. And then we're going to split the profits and proceeds when we sell that property. That's definitely a strategy we see people take advantage of often. Right there into joint ventures. So I'm bringing asset A to the table, whether it's cash or whether it's a physical property already owned in my retirement account. Investor B is bringing asset B to the table, whether it's construction expertise or the cash needed to do the upgrades and transition of the property. And then between you and that joint venture partner, you decide in a joint venture agreement exactly how you're going to split the profits and proceeds when you sell that property in the future. Very similar to the rental agreement that I mentioned earlier. That's completely up to you. We have no jurisdiction. It just has to be positive income producing as a passive investment. So you can't set a 0 interest rate or just say, hey, I'm going to come out of this deal intentionally at a net 0 or potentially even at a loss. That's something we're not going to allow to be processed on paper, because the IRS always wants these things to be intending to generate passive income. So I've got 3 or 4 case studies here for you guys, and then I'll open Q&A after I get through these. So my first case study is investing into a real estate syndication. So I've got a woman who's got a managed retirement account. and she meets a gentleman that's on a general partnership team or doing capital raising for a syndication deal. They sit down and review what's typically referred to as the PPM, the private placement memorandum, or the prospectus on the deal. And she does a thorough review, consults with whatever her team looks like, and decides, yes, I want to participate in this investment. So she goes ahead and sets up a self-direct account. She does a custodian to custodian transfer to get that account funded. And once we have the account open, while we're waiting for the funds to come in from that previous company, we can go ahead and get her approval of the subscription paperwork so that we're ready to execute this investment as soon as the funds are in the account and ready to go. And what that looks like is we make sure the subscription paperwork is listing this individual's retirement account, just like I said earlier with the deed of title on the physical real estate. We make sure there's going to be enough money in the account to fund this investment and where we need to send the funds to, whether it's a check or a wire. We make sure this client reads and approves all that paperwork. And then as soon as the money's in their account, we go ahead and execute the transaction, fund the deal. And again, for a rounded number example, this is a $50,000 investment that pays 8% preferred distributions each year. So that's $4,000 a year. After 5 years, that project is refinanced. So the group that made the initial deal finds a buyer for the project. They've maybe upgraded this commercial property from a C level to a B or B plus, whatever their structure is and their asset class they're going after. And then they sell that deal to another investment group. Let's just say this deal goes very well. In this case, it did go very well. And the lump sum payout at the end of the deal when it went full cycle was $65,000. So for this investor, having a $50,000 investment for 5 years, she generated $35,000. Again, you may not see this in your actual running case scenario when you find this type of deal, but this is actually common as well. So you may find a deal that pans out exactly like this. That's $35,000 of either tax-deferred or tax-free income that is not subject to capital gains and can be reinvested into the next project or the next multiple projects at your discretion and at your leisure. My next case study here is just investing in real estate. Again, whether it be for a long-term hold for appreciation, for rental income, short-term, mid-term, long-term, whatever it may be. So I've got someone that's got an old employer plan and they find a property that they want to invest into for $200,000. They go ahead and get the account set up. They initiate a rollover to get the funds moved into this account. And they start working with their account manager and the closing office or attorney, agent, whatever your jurisdiction requires, to get the contract and everything ready to go to closing. Again, these are cash deals in most case scenarios, so we can close pretty quickly. We just need to make sure that the retirement account's listed on all of the paperwork so that it's appropriately the owner of the property. In my scenario here, the $200,000 property is rented out for $1,500 a month for 2 years. That is $36,000 of income. And then the property is sold for $75,000. So that's $111,000 of profit generated that is not subject to capital gains, that is either tax deferred or tax free. So that person now has $311,000 to reinvest into, at this point, maybe 2 properties, maybe one nicer scale or nicer quality property. However, that investor plans to turn that money once it's already gone full cycle with this project, that's fine. They could have held on to it for 10 or 15 years and generated maybe even more than $1,500 a month in rental income. Another thing to note here with this scenario and with this case study, I did not take into account any possible rehab work or upgrades to the property. So that $111,000 may be a little bit lower if you had to put a new roof on the place or paint the walls or change out any doors or windows, things like that. So keep that in mind. I was just trying to use a very simple rounded number case study. Next one is fix and flip investing. So very similar to what I just went over, but a little bit faster pace and quicker scale, involving undoubtedly the rehab costs that are going to go into flipping a property. So in this case scenario, I've got a guy that finds a distressed property in his neighborhood. Maybe it's right up the street and it's an eyesore and he's got this retirement account and he wants to improve it for the overall benefit of his community. So he finds a distressed property, he buys it for $150,000 and he thinks it's going to need $25,000 of rehab work to get it up to standard to where he can sell it for a profit. So once he has the property purchased and deeded, titled in the retirement account, He can then start coordinating with the vendors of his choice for all that rehab work. Again, he can go on site, make sure he inspects the work and it's done to quality and standard before he pays these vendors out. And then whatever cycle or timeline this takes, he can turn around, list his property for sale, rent it out once it's rehabbed, whatever he may want to do. In this case scenario, we're just doing a quick turnaround. We're fixing the property, we're turning it, listing it, selling it to an end buyer, another investor, whatever it may be. And in this case scenario, that property was sold for $275,000. Sorry, I jumped ahead there. $175, forgive me. No, he invested $175,000 in it. He sold it for $225,000. So that $50,000 of profit, whether it be 2 months, 3 months on the full scale cycle of timeline for this type of investment, can then be reinvested. One key thing to note here is that you're allowed to do this with your retirement account pretty much as you want to or can do with the balance you have and your timeline and cycle. But when you start getting to scale within any given year, you're going to have to look and speak with your CPA or tax preparer at what's called UBIT tax, unrelated business income tax. That is where you're making investments with your retirement account that start to trend towards running an actual business or generating more active income than passive income potentially. So there's no black and white rule on this. We kind of say our rule of thumb is if you're at an upward scale of 5 to 7 flips per year, speak with your CPA or tax preparer, make sure you get their feedback and opinion if you should submit and pay UBIT tax for this. The main thing here, as I just stated, the IRS doesn't want to see you actually running a flipping business through your retirement account. It should be something that's strictly passive income, but when you're getting to scale and there's other people out there that are doing that through a business entity, you may be at a threshold where you need to submit and pay UBIT tax, which could cut into some of the margins, but it could still be profitable for you. That's really outside of my kind of scope and wheelhouse as to what that looks like if you're at that point. So that kind of concludes my case studies. I want to let you know it's real simple to set up a self-directed account. Our application takes about 10 to 15 minutes to get the account opened. It takes about a week or so to get the account funded, and then you can start investing. So you may already have a deal on the table you want to invest into. And before hearing this, have thought, oh, I don't have enough time to get this done, or there's no way this is going to work out. It's too costly. Again, we can get this opened, turned around, ready to invest in about a week and a half or so, roughly. The costs for our accounts are roughly a few $100s, not a few $1,000s per year per client. Reach out to me directly if you want to receive a copy of our fee schedule. I'd be happy to share that with you. And we also have a lot of other free educational content. As I mentioned earlier, we put on 2 educational webinars a week, just like this one, but we bring on guest speakers a lot. We have different nuanced topics like the checkbook control strategy I alluded to briefly earlier, like the UBIT and UDFI tax that I very briefly alluded to, like flipping properties, joint ventures, other asset classes outside of real estate. So we always record those on Tuesdays and Thursdays from 12 to 1 p.m. If you register for one of our webinars, you receive a copy emailed to you automatically once the recording is rendered. And they also go up on our YouTube page. So you can look up Advanta IRA on YouTube and find a really deep catalog of, I think, 7 to 10 plus years of previous educational webinars. We have a podcast called the Alternative Investing Advantage Podcast. My colleague Alex Perney hosts that. He brings on guest speakers, and it's more of a free-flowing, relaxed conversation, not as strictly educationally driven content on that. And we have a blog on our website as well. If you're interested in some of the industry standard kind of techie, nerdy news about the retirement account industry, you could check stuff out there. A few years ago, I always use this example. There was some legislation going through that was going to eliminate the ability for a self-directed investor to have a checkbook control LLC. We put out a blog post about it. We put out a change.org petition on it, and we got so many signatures on that that we actually were able to get that legislation modified and get that aspect of it removed from what was eventually passed. So really good stuff and content there. Here's my contact information if anyone wants to reach out to me directly for anything further. For those of you that weren't here before we officially started, I'm happy to send a PDF of today's slide deck to you if you email me and you want a copy of it. I know this is being recorded as well, so maybe you just want to watch it back. In any event, reach out to me if I can answer any questions or help you with anything further. And that concludes kind of the presentation side of things. I'm happy to stick around for as long as you guys have questions. I can answer any one-off questions either I didn't cover or relates to self-directed investing, but wasn't necessarily related to what I talked about today. Thank you guys so much for the time.
Yeah, thank you, Corey.
Thanks,
Corey, pretty awesome. I know there's gotta be some questions. I know I have some if no one else does, but go ahead, who's got one?
Hey, Ashley, hey, it's Hoke.
Hey,
Sorry for being late, but I
Right.
appreciate you putting this on, Corey. Thank you for your time. Are you using the term IRA interchangeable with the SEP? Because I have my SEP IRA. I'm just making sure.
Yeah, Hoke, I spoke about that pretty early in the presentation. Maybe you
Okay,
signed
yeah,
on a little
sorry
bit
about that.
after.
Okay.
Yeah, no, you're fine. A SEP IRA, a simple IRA, a solo 401k. I'm using the term IRA through this presentation interchangeably. We do offer all of those plan types to be self-directed. The main thing with the SEP IRA, which you may know because you have one, it is an IRA account, but it's also a small business or employer-sponsored plan type. So it's a little bit different from a traditional and a Roth IRA, which anyone in the US can have and contribute into as long as they have earned income.
Right.
Those SEP IRAs like Hoke has is an employer-sponsored IRA plan. So if he has employees, based on kind of a chart he has to fill out when he opens the SEP IRA, he may or may not have to allow his employees to participate in that plan. But it is a plan that we offer, and I am, for context of the presentation, using that interchangeably, yes.
Okay, thank you.
You're welcome. Anything else? Don't be shy. I'm here to answer anything that you guys have. No questions too small or too silly.
Hey, this is Erin Brinkman. I just had a question. I have a SEP IRA and I mean, this seems obvious, but I just wanted to make sure, you know, if you're using it to purchase real estate, you can't touch any of that until without penalty until age 62. Is that correct?
So when you say touch, do you mean the money that it's generating, or do you mean utilizing the property for personal purposes? Can you elaborate on that?
Yeah, I mean the money in the SEP IRA. Like, I mean, if you're making passive income, it's just going to go into your IRA until you can touch it at a later date. You can't take anything out of it without penalty until that time.
Correct. So the money flows back into your retirement account directly. The age you referenced, 62, it's actually 59 and a half. So
Okay.
anytime you want to take a distribution out of a tax deferred IRA before you've reached age 59 and a half, there's a 10% early withdrawal penalty. Now, if you have a Roth IRA, which you and Hoke may or may not know, about a year ago, they started allowing SEP IRAs to have Roth funds in them. If you have a Roth IRA, there's a separate set of rules that are a little bit more nuanced. With a Roth, typically you have to have what's called a 5-year seasoning period or vesting period for the money that's in that account before you can start taking completely tax-free distributions out of it. If you absolutely have to or want to take money within those 5 years, they take it as a waterfall chart. I think it starts with new contributions you put into the plan, then earnings you've generated from the investments you've made, and so on and so forth, of the actual money and buckets of money from the IRS's eyes that you have sitting in that plan. But in general, to answer your question most broadly, 59 and a half is when the early 10% penalty stops hitting you, and you could then, after that age, take money out of the account. It is added to your ordinary earned income in the year you take it out. So let's just say, for example, you make $120,000 a year at your job, and then you take out $20,000 of your retirement account. Even if you don't get hit with that 10% early withdrawal penalty, you're adding that $20,000 to your earned income. So keep in mind and speak with your CPA or tax preparer. That may bump you up into the next tax bracket because you're having to report on taking that money out of that tax deferred account.
Okay. And I've heard that you can use money from a SEP IRA to purchase your first property, but it has to be a residence where you live. It can't be an income property.
So no, and that rule I don't know where you may have heard that. There may be a different nuance than I'm familiar with. But if you're going to use money in your retirement account for any property that you're going to personally benefit from, whether it be a dwelling that you're going to live in or a rental property that you plan to vacation to, you're really not allowed to do that. You would have to take a distribution out of your retirement account so that that money is free and clear in your hands to do what you want with it. There's no specific loan or leverage point of your retirement account to benefit yourself personally. I'd maybe want to hear exactly what or where you heard that from and kind of break that down a little bit further. But nothing that I'm aware of would allow you to do what you described.
Okay. I've heard it from some CPAs, just like as an exception, but yeah, I don't know.
Not to my knowledge of the IRS rules and regulations, but they may have some sort of loophole that we don't necessarily agree with or see the same way from the IRS's rules and standpoints. There are CPAs out there that have, I'm not saying you're a CPA by any means, but that have some unique strategies that we've definitely had to say we don't sign off on, for example.
Okay, thanks.
You're welcome.
How does the required minimum withdrawal kick in? If you invest in something that's not that liquid, how do you address it?
No, that's a great question. Thank you. So the required minimum distribution as of right now kicks in when you're, I believe, 72 and a half. When I started in the industry, it was 70 and a half. In practice, it seems like they keep raising the age as the life expectancy keeps going up. So by the time everyone in this audience reaches it, it may be 82, 83, who knows? But how that applies is that for each retirement account you own, the administrator is going to tell you what your required minimum distribution is based on the value of that account and the IRS's life expectancy table and your marital status, basically. So there's a chart. You can go to the IRS's website and look up the RMD chart. And once you know what your required minimum distribution is for each of your retirement accounts, you can take that amount from any retirement account you hold. So if you have a retirement account that is not as liquid as others, you can say, okay, my RMD for this illiquid self-directed retirement account, this physical piece of real estate I have, is $14,000. I can go over to my brokerage IRA account with the fiduciary company and just draw that $14,000 out of that account, plus whatever RMD amount that they require for the asset holdings and value you have with them. Another thing that I can piggyback on this that relates to real estate investing specifically is you can take a portion or an entire property as an in-kind distribution out of your retirement account. So strategy-wise, I would never say, hey, buy a property in your retirement account that 20 years down the line, 10 years down the line, you want to be your retirement property. But in practice, people can do that. It's not a strategy you specifically for the IRS's standpoint should go into and plan for. But let's just say you had a property and things worked out where you decide, hey, I want to go live in the lake house for the rest of my life. You can take an in-kind distribution of an asset. In this case, we're talking about real estate. In order to do so, you'd have to get a certified appraisal done within 30 days of executing the distribution request. And whatever that property is appraised at, you're going to take either a portion of the ownership out to satisfy your RMD or the entire value of the property out if you want to start utilizing it for personal purposes. And that certified appraisal is going to designate what the value or percentage value of the property you're taking out is. And that value is going to go against potentially your RMD requirement, or in general, even if you're not at RMD age yet, the total value that you're reporting to the IRS for your tax deferred account status.
Thank you.
Mm-hmm. Any other questions, anybody?
Yeah, what happens when you said you can lend money?
Sure.
If you lend it against real estate, how do you secure it? Is it you just take a deed of trust and put it in the name of the self-directed IRA?
So if you're lending in any capacity, you have the discretion to issue that as a non-secured promissory note between you and a borrower. I wouldn't necessarily advise to that because there's no recourse if the borrower were to default on the loan. Otherwise, what most people do is secure it by a physical piece of real estate or any other asset for that matter, that you can claim if the borrower were to default. Now, there are, I wouldn't say caveats here, but let me just give you a case study. We've had somebody secure a private loan with a vehicle, and then they had the borrower default. They had to go claim the vehicle. I think it might have been like a Hummer, for example. As soon as they claimed that recourse and received that Hummer deeded and titled into their retirement account, they had to turn around and go sell it immediately, because that as itself is an asset that the IRS doesn't want you to hold in your retirement account. So typically you're securing the loan by the actual property being lent against. It can be secured by other pieces of property, whatever they may be, but just keep in mind whatever that security instrument is, if you do have to claim it as a default on the loan and actually collect it within your retirement account, make sure the asset's something you're allowed or should be having in your retirement account, or that you have a quick exit strategy to liquidate that asset out in exchange for cash. Did that answer your question? I think you had an aspect of it of like a property on your listing, which in itself I'm not too familiar with, but can you expand on maybe the case study or scenario in which you're talking about?
No, you hit it right on the head. I was just thinking, so basically if you loan money from your self-directed IRA, and things went south, then your self-directed IRA would foreclose on the property and take it. And then the self-directed IRA would actually then own the property.
Correct.
Yeah.
And even taking that one step further, if you own a property in your retirement account, you can be a seller financed seller. So your retirement account can sell a property to a third party and then actually be the lender through that sale transaction. So you may not get all of the cash in hand right when you sell the property, but you're getting a secured note against that property and payments coming in at whatever interest rate you decide on from the new owner of the property as well.
Yeah, okay, that's cool. I've got another question if no one else does. With real estate, a lot of times you have depreciation and or taxable losses. So how does that play? The self-directed IRA is not like a taxable entity, I guess. So if you have a K1, does the self-directed IRA get a K1? And if so, if it shows a negative number, what happens?
That is a great question, topic that gets brought up all the time. I'm sorry I didn't expand on or allude on that earlier, because I typically bring that up myself earlier in the presentation. But the tax benefits of investing with your retirement account are that you're generating tax-deferred or tax-free income, and you're not subject to capital gains when you sell the property. The handoff on getting those benefits are that this investment is held in your retirement account. It's not held by you personally, so you are not allowed to take advantage of depreciation for these types of properties. It's a completely separate investor and entity that's holding this property than yourself. So K1s are typically not issued for a physical piece of real estate, and you're getting the handoff of you can't take advantage of those things, but you can take advantage of the things that the retirement account offers. Now, when you're doing syndication investing as a limited partner, K1s are issued annually to all limited partner investors. Those just basically get filed on your account for record keeping and reference, but they have no basis or support to the actual valuation of that investment, because the K1 is a historical representation of the investment, not an active current value. And let me expand on that too. What we require, pretty much the only thing we require, is an annual valuation of each asset held in a retirement account. Even your fiduciary or financial advisor companies, whether you know it or not, have to do a fair market value each year and report the value of each of your assets to the IRS. For real estate, the quickest, easiest way to do that is to just go on the county appraiser's website and look up the appraised value of the property. When you do reach RMD age, this is a big thing to note as well. once you reach RMD age for any property owned in your retirement account, you do have to get a certified appraisal at minimum once every 3 years. So that's the only caveat there. And then again, if you want to sell the property or take it as a personal distribution, you're supposed to get a certified appraisal as well. Well, not necessarily if you want to sell the property to a third-party buyer, but if you want to take it as a distribution, you do have to get a certified appraisal on that property. But we have to collect a valuation for every asset held, and a K1 is not a supporting valuation determinant. It is provided with those syndication investments and private equity, private stock type deals, but we just save that to your file and store it as a document relative to the property, but there's no further taxable value or benefit to having it.
Okay. Corey, if there's no other questions, I wanted to share my screen if I can, if I'm.
Yeah, I'll end my screen share now. See where my thing jumped to. All right, so I just stopped sharing.
Michael, if you have it up, I have it up. I'll stop mine. So I wanted to share you, so something that Michael and I are working on. So we fall into that syndication scenario that you talked about earlier. We have this property. So we're the general partners or the syndicators. And we have LP investors, limited partner investors who have invested money into this property and to other properties. And we even have two of them who have invested self-directed IRA funds into our properties. So it's pretty cool. It's a great tool. And I wanted to do this session because it's pretty obvious to me in talking to people when we're out raising money that not a whole lot of people know that they can use a self-directed IRA to make investments. So thank you. Today was fabulous. We're still taking investments on this property. It's something that we already own. It's in Jacksonville, North Carolina. We've already, stabilized it, and we're in the process of refinancing it to a HUD 223F loan, which is a 35-year fixed, 35-year amortization loan. And I see the
I'm having issues.
That's okay. That's okay. It wouldn't be a presentation if we didn't have at least one tech glitch. But the point is that this is one of those very hands-off things that people can invest in. And so if you've got money in your retirement funds and you want to diversify or, dip your toe in the water of real estate, investing with a general partner into a syndication is a great way to do it, because you don't have to do anything past the investment. All you do at that point is receive updates, and hopefully you receive cash distributions. And then when it sells or refinances, you get a big lump sum back into your retirement account. So you'll see the deal at a glance on this one, $50,000. We're raising an additional $4 million, and we're projecting an average annual return of 20% or more, with the cash on cash average return of 6.5% or more. And we're projecting a 5-year hold. So, that may or may not be more than you're making now in your IRA or your 401k. That's, everybody's situation is different, but it's probably a little bit more, and it's probably just a good way to diversify. Anyway, so we wanted to share this because we think that it's a great opportunity. In 5 years, we're projecting you can more than double your money.
Yeah, and the way this works is exactly kind of how Corey described, where you have a cash on cash distribution that comes out quarterly. So the way the table reads is kind of along the bottom, you see the percentage related to the cash on cash. It might be anywhere from 5 to 7% per year. But then the big return comes at the cash out in the cash event, when we either refinance or sell the property in what we're projecting to be year 5. that's when you're made whole on the investment. And then, ultimately the large cash injection creates a doubling of your investment.
Yeah, it's pretty cool. And Michael, scroll just a shade. At the bottom of the screen, you can see, you may have to just zoom out one. But our contact information is there at the bottom. My phone number is 910-409-0861. And my email is ashley@avgmultifamily.com. If anybody has any interest in talking about this or other types of these things, that's what we do all day, every day. There it is, contact info, and our website, of course. And I think that's about all the presentation that I've got.
Yep.
Anybody else have questions or anything?
It's a lot of information.
Yeah, it's a lot to digest, isn't it?
Take in.
Yeah. Well, one thing, it is a lot to digest, but what I found is there's always somebody who knows how to do it.
Yeah, yeah.
And so,
yeah. And it looks like there's a lot of resources offered and,
Yeah.
Just getting started and.
I will tell you that Corey actually helped one of our investors who invested with the self-directed IRA. And it was a very smooth process on my end, and I was monitoring it on the the investors' end. And it appeared to be a very smooth transaction for the investor, moving money from a traditional IRA to the self-directed. The feedback I got was that it was as easy as you could get. So I definitely think it's something that you should look into.
Yeah.
Well, thank you so much for the vote of confidence there. As I mentioned earlier, if you guys are interested in your own account or you have investors that are, you can make a direct referral introduction to me. I basically help that person through the entire onboarding process, and they just get handed off once to a client account manager who then is their direct point of contact and helps them execute the actual investment transaction. In line with something like that, I've already got the relationship to you who made the referral to them. So in the background, I can start making sure their syndication paperwork is already in our hands and we're getting that client to approve it. And again, just one handoff from me as their initial point of contact and onboarding specialist to their client account manager, who's going to help them through the duration of their account with any questions, executing any investments, other strategies they may show interest in. We really try to provide that white glove customer service and bring a lot of good education, information to our audience so that everyone's happy. And again, paying on the lower end of the spectrum as well for the services we offer relative to the broader industry of self-directed accounts.
Awesome. Thank you, Corey. Thanks everybody for showing up, and we'll let you know when we have another one. Appreciate it.
Thanks, Ash.
Thanks.
Thank you so much.
Guys.
Thank y'all.